Imagine waking up tomorrow and discovering your bank account is frozen. Not hacked, not stolen, just inaccessible. No transfers, no withdrawals, no explanation. Temporary review. For most people, that would mean instant financial paralysis. Rent, bills, food, mortgage, everything stops. Now here's the unsettling part. People with the most money are the least exposed to this risk. Meet Olivia, tech executive. Net worth in the low seven figures. You'd assume most of her wealth sits safely in a bank account. It doesn't. On any given day, her checking account holds just enough for routine expenses. The rest of her wealth lives elsewhere. Assets, funds, businesses, treasury instruments, real estate, private investments. Because wealthy individuals understand something most people never question. Banks are designed for transactions, not wealth storage. Historically, banks can fail. Access can be restricted. Withdrawal limits can be imposed. Even in stable countries, temporary liquidity issues happen more often than headlines admit. But the bigger reason isn't fear, it's mathematics. Cash in a bank quietly loses purchasing power every year due to inflation. While your balance stays the same, what it can buy shrinks. To the wealthy, idle cash is a wasting asset. So instead of storing money, they deploy it. Money in motion tends to grow. Money sitting still tends to decay. Here's a fictional but realistic scenario. Michael sells his company for $4 million. Overnight, his bank balance explodes. Friends assume he's set for life. But Michael's advisor moves most of it within months. Diversified funds, income-producing assets, tax-efficient structures, short-term government securities. His visible cash drops dramatically. On paper, he looks less rich. In reality, he becomes far more secure. Contrast that with Jason, who keeps most of his savings in standard accounts because it feels safe. 10 years later, Jason still sees the same numbers, but inflation has silently eroded a large portion of his real wealth. Safety without growth can be a hidden form of loss. Another quiet reality: large balances in a single institution create concentration risk. Wealthy individuals spread exposure across multiple vehicles, not just multiple banks. Not because they distrust banks, but because they understand systems. The public is taught to accumulate money. The wealthy are taught to position money, and positioning changes everything. If your financial survival depends on one account, one income stream, or one institution, you don't just have savings, you have a single point of failure. So the real lesson isn't that banks are unsafe. It's that true financial security rarely sits in one visible place. Because the richest people don't just store money. They engineer where money lives, how it moves, and what it earns while they sleep. And once you see that difference, you realize wealth isn't a number in an account. It's a system working quietly behind it.